Hello, Culture Matters podcast. Before I introduce you to our guest, here's a quote I picked just for this episode. We finance everything we buy by printing interest or giving up the interest we could have earned. Nelson Nash, my dear friend, Chad Hewitt of Magnum Construction Services is back. Episode 142 of the Culture Matters podcast. If you haven't heard it, listen to that podcast after this episode. Very different conversation than we're going to tap into today. We're going deeper today. Chad, who started his business with some scaffolding and turned it into something that was growing over 20% per annum, is a total beast. And I had the pleasure of meeting him at a mastermind type event. And brother, thanks for coming back to the show. I'm excited to pick your brain about Nelson and everything you got going on.
Yeah, no, I'm excited to be back, and thanks for having me back.
So I guess in the essence of that quote that we were talking about before this, right? We finance everything we buy by paying interest or giving up the interest we could have earned. What does that mean to the lay person listening to this that's trying to make it in the world in their long-term wealth building as an entrepreneur or whatnot?
Yeah, so great question. So basically, that phrase was coined from Nelson Nash, who is the father of the infinite banking concept, becoming your own banker. And basically, he was he was a deep thinker, and he had a background in forestry and a background which led into life insurance. And he was thinking of the need for people's finance in their life when it came to products and life insurance. There was more of a need for finance in your life than there was for death benefit. And he came up with the concept that you're either giving away interest or paying interest, giving away interest on money you could be earning if it was yours, or paying interest from someone else that you're borrowing it. So essentially, he made his product out of whole life insurance that would allow you to be your own banker, so that when you are paying interest, you're paying it to yourself, and when you have money on deposit, you're gaining interest on your money, basically.
Is part of the value of that is to offset the inevitable inflation that attacks all our money?
Well, I mean, with this product and this wealth building strategy, there's so many ways that this can be used to hedge against inflation, to do asset protection, to do estate planning. So I can kind of just give you an overview of what the base foundation of it is, which is it's basically a place to store money that's outside the banking system, that you have full control of. And it's built around dividend paying mutual insurance companies that are A-rated, that have a 150-year track record of being in business, have seen every up and down that economic times in human history can throw at it, from the Great Depression to all the different financial calamities we've had over the past decades. And they've weathered the storm, and they rarely fail. It's very, very rare that an insurance company fails, versus if you look at how many banks fail. Right. If you just Google how many banks have failed in the last 20 years, it's staggering versus the amount of insurance companies, and moreover A-rated insurance companies like a Mass Mutual, these big insurance companies that are some of basically the most liquid companies on planet Earth. They have the most cash reserves, way more than banks. They have different liquidity ratios. So the whole concept is basically thinking about where do you store your cash, right? Everybody needs to store their cash somewhere. And society has just conditioned us that we need to store it in a bank, right? When you think of where you're going to put your money in a strictly cash form, you're just basically trying to figure out, okay, what bank can I put it in, or what bank type product can I put it in? Where Nelson Nash came up with this whole idea based around dividend paying whole life insurance companies, and having a low death benefit, but structuring the policy so that you can stick as much cash value or cash in the policy as possible. So what it does is it basically gives you cash on deposit at one of these life insurance companies that you can draw from at any time.
Do you find that the wealthy, because you network like, I think with the best of them, from my observation, and you're constantly learning and seeking to develop your companies and investments. Is it that the wealthy or those that pursue wealth don't they invest differently into the future than the general populace? Like it's a completely different mindset.
Yeah, no, absolutely. And that's what kind of attracted it to me, because I'm always, if everybody is doing it, the 401ks, the IRAs, the savings, CDs, money markets, if everyone is doing that, and then you get behind the curtain and you talk to people that have 8-9 figure net worths, and you find out that they're all talking about high cash value life insurance policies, which is what happened to me, that lit a fire. And I'm like, well, why is everyone with the 8-9, $100 million net worth, why are they only talking about high cash value life insurance? So I went down the rabbit hole, and I started my first policy in 2016, and I just started it with a base amount of information. I knew what it could do. I knew successful people around me were doing it, and it literally took me 2 years to unpack all of the different ways that this product can be utilized. There's a lot of negative talk about whole life insurance policies, but those policies are not structured like the policies that the uber wealthy use, and they use this as a means of creating and passing generational wealth. So typically,
Wow.
Ultra high net worth individuals, as soon as they have a new family member born, son, daughter, granddaughter, etc., they open these policies on them and start funding them, so that they're building their own bank, that person can utilize throughout their lifetime. And God forbid something happens to them, the death benefit comes to the family, and that continues to fund additional policies and etc.
Is the idea a big part of this, that the way that wealthy families and individuals grow that wealth is through leverage, but tax incentivized leverage? Like the reason I asked that is when I was researching for this, there was this notion, correct me if I'm off on this, that if I'm putting into my own bank in that way, I'm putting the cash value. If I want to go buy an investment, like whether it's like a piece of real estate, I can borrow against that money that's wrapped into this, under this insurance or within this insurance policy. I can actually borrow against that and buy an asset. Is it about the leverage piece?
Yeah, no, it's all about the leverage piece. I'm a real estate investor, and leverage is a big part of what I do, and understanding how to get credit spreads, things of that nature. So basically, when we're talking about, and the thing I really like about this policy is you don't have to be ultra wealthy to do it. Anybody with a, six figure, $100,000 a year or $75,000 a year, anybody can start one of these policies, right? So that is the great thing that I like about them, because a lot of things that ultra wealthy people are into, you can't do it unless you're ultra wealthy. So this is something that the layman can do up until the, multi-millionaire, whatever the case is. They can build these policies. So what I always tell people when they ask me about investing, I'm saying, well, first of all, before you even be getting worried about investing, first of all, you need to have 6 months of just cash. What are your living expenses? If your living expenses are $5,000 a month, then the first thing you need to do before you start investing in anything is you've got to build 6 months of reserves, and that can't be touched. Now, great place to start building your reserves for your cash value, or just keeping those reserves, is in a place where you've got liquidity, and you've also got the added benefit of this death benefit. So instead of just going to your local bank and opening up a savings account and accumulating $30,000 in there, you can start one of these life insurance policies. And let's just say that you figured it would take you say 2 years to save up $30,000, let's just say. So for the next 2 years, you're just putting the $30,000 in at $15,000 a year. And then you've got your $30,000 sitting there that you can borrow at any time if there's an issue, if you run into some sort of unforeseen black swan type event, you've got your liquidity there, and then any capital that you put in there after that, you can reinvest. Now, that money is sitting with the life insurance company, just like it's sitting with your bank.
Okay.
But you're getting a guaranteed contractual rate of return on your savings that's in there. And typically it's 3 to 5% from one of the mutual companies. And then because you're using mutual companies, if you have a life insurance policy, you're actually a part owner of the company. So you share in the dividends. So at the end of the year, they do a dividends pro rata to your shareholding in the company. And that usually equates to another, 1, maybe 2% that gets added to your savings account, right? So you've got a savings account that's making, let's just call it 6%, right? But if something happens to you, you don't just, there's $30,000 that's going to go to your family. You've got this death benefit that's maybe $200,000. So if you're going to save money, you might as well have the extra benefit of having a death benefit, right? If something happens to you. So the way that I've worked it is that I've gone to proceed to have a minimum amount of liquidity that I keep at all times at these life insurance policies. And that is, emergency money. When I get to that number in the policy of the cash value, I consider that there's nothing left, right? Anything over and above that is strictly for investing purposes. So the way that I run it is, let's just say I'm putting $1 million a year into that policy. I'll put $1 million into the policy, and then I'll go buy look for a real estate or some sort of investment where I can create some arbitrage between what that money is going to cost me to borrow out of the policy versus what I'm going to get of a return on the investment. Most of my real estate deals, they pencil out between 15 and 25% on an ROI, II type situation when I look at a long-term pro forma. So let's just say I put my $1 million into the life insurance policy, and now I can call a life insurance policy and borrow the $1 million back out and go put it into a piece of real estate. But what a lot of people get lost on is the fact that you still have the $1 million inside the life insurance policy that's making the 6%, right? So all your money
borrowing
inside
against
the policy, you're just borrowing against that $1 million. So
that's the leverage piece.
Exactly, that's the leverage piece. And the thing of it is I don't have to explain what I'm using the money for, where I'm putting it, because it's actually not $1 million that you draw out against the policy. It would be more like, say, if you actually had $1 million of cash value, they would loan you about $980,000. So they're always going to be $20,000 ahead. So it's a cash secured loan. So you get really favorable terms on it. You go ahead and you can buy property with it. So now I've taken $1 million, making 5 to 7% inside the policy, taking it out. I'm using it to put down on a down payment of, say, a $4 million property. Right. So now I've got it working with leverage in a $4 million asset, and I've still got the $1 million of cash value in the policy, and I probably have a $5 million death benefit if I have $1 million cash value. Right.
I'm following you.
And then just to add a little bit of a twist, if God forbid something happens to me, I've always told my wife that if anything happens to me, because I do all the real estate investing, I control all the cash and do all the loans, and we have a considerable amount of debt. Well, the debt that I have would be instantly wiped out from the death benefit that would be left over, from these life insurance policies. So my wife wouldn't inherit a bunch of loans and stress of having all this, tens of millions of dollars owed to banks. It would all be wiped clean, free and clear. She'd have cash flow coming in with no expenses from these properties, no mortgage expenses, and she would still have considerable amount of money left over and just dry liquidity from these insurance policies.
For those that haven't listened to episode 142,
briefly,
what is it that your business Magnum is and has been? And then the follow-up to that would be what type of growth and different types of problems, meaning like, they say the more money, the more problems, or the more success, the more responsibilities, kind of presuppose this investment pursuit.
So I had a scaffolding company, and reading the Robert Kiyosaki books, they were saying that you want to be able to build a business with the main goal of that business is to make money to buy real estate. So I've just added a piece to that puzzle, which is have a business, generate cash, put that cash into high value life insurance policies, then borrow it back out to buy real estate, because you're actually being a lot more efficient with the money by having it in two places at one time. And then the end goal for me is that when I sell or refinance these properties, the money that has been borrowed out against the policies to buy them, she gets paid back to the policies. So I'm recycling the cash back in it. So the plan for me, take money out, pay the interest only on that debt. I'm not trying to pay the principal down. on the debt, because on the side borrowed from the bank, I've got a tenant in there that is making, monthly principal and interest payments. So I've got two loans on the property. One is an interest only loan to myself. The other one is being serviced by a tenant that I owe to a bank, and every month that is being paid down in principal, with the idea being that every 5 to 10 years, the property is either sold or refinanced. The proceeds are then taken back and put back in the life insurance policy.
And what are the advantages of that?
Well, the advantage of that is that that money that's inside the policy continues to compound, right? So you're basically creating that credit spread on the money that's borrowed, right? So basically you're turning every investable dollar into $2, right? Because if I just took my money that I made from my scaffold company and put it into real estate, I would just have real estate, right? But with what I'm doing right now, I'm putting it into cash value. So I'm building an asset over here. I'm building cash value and death benefit, right? And then I'm building a real estate asset. And if you look at the arbitrage, because I'm always creating cash flow with the money that I'm borrowed, it's not a negative cash flow situation. So I'm making on the million inside the policy, right? I'm making, say, 7% on the million inside policy. On the money that I borrowed outside the policy, I'm making cash flow, and I have an asset that's 100% financed, right? So if you look at,
well, just to be clear, that's because the down payment is coming from that loan against the policy, and then there's a debt taken on the asset, if of real estate, from like another lending institution.
Correct. And then the beauty of this also is that you can buy assets with 100% leverage, like real estate, that will give you a very real, tax break, right? So last year I bought a $6 billion property. I paid the entire down payment with cash value from my life insurance policy, right? I'm getting a little bit of cash flow out of that property, but I did a cost segregation study on it, which is hiring an engineer to come in and basically have you be able to depreciate the property as fast as possible and get a big chunk of depreciation. And by buying that property, I garnered a $1.4 million tax deduction, right? So if my scaffold company this year makes $1.4 million, that will be offset by the loss from the depreciation of buying this property. And I did that with 100% financing with someone else's money.
And is one of the ideas here is that when it comes to business owners, when it's not as much as what you make, but what you keep.
Yeah, it's definitely what you keep. And also for business owners, if you're not someone that really is looking to, buy a bunch of real estate, but you still, you don't know what to do with your cash, you can build it up inside these policies. And if you see some opportunity in business, you want to buy some more equipment, you want to grow your business in some way, you don't have to go through all the hoops and hurdles of going to a bank and explaining, getting out all your documentation, your financial statements, credit score, all that stuff. If you have cash value there, you can just take a loan against it. So what is happening inside that policy, and people always say, well, why would I want to pay money to borrow my own money that I just put in this policy? And what you're paying for is the magic of compounding interest, and moreover, the magic of uninterrupted compound interest, right? Because every time you put money into that policy, and like I said, this was designed by someone that was in the forestry industry. So when they're looking at designing forests, they're thinking in 50, 80, 100-year blocks of time. They're not just thinking in very short increments. And when you look at one of these policies, if you start funding it with even a modest amount of money at a relatively young age, the hockey stick that occurs is astronomical when you get out, when you get out on these things 20, 30, 40, 50 years, depending on when you start funding these policies. So the magic of it, and I really like the leverage, is let's say you're putting $100,000 a year into a policy. And this is where people get kind of turned off, because when you start funding these policies, put $100,000 in year one and you don't have access to $100,000 of cash value. Maybe you have access to $70,000 or $80,000 of cash value. But if your long-term plan is, I'm going to put $100,000 away for savings, investments, emergencies, and that could be $10,000 a year, pick the number, doesn't matter, that you're going to put this in every year regardless, right? Now, if you put your money into a savings account that's making next to no percentage, you're basically every year you put your money in, yeah, you might have $10,000 the first year, but you have 20,000 the second year, 30. When you're doing with life insurance companies, you put 100,000 in. After 5 years, typically you're at break even. So if you put 500,000 in the policy, you have 500,000 of cash value. But where the magic really starts happening is on the 6th year, you put your 100,000 in. Now you have 600 and say 20,000 of cash value. The next year you put another 100 in. Instead of having 720,000, you have 750,000 of cash value. So you're putting 100 in, but it starts to grow exponentially after that point. So you're getting the leverage of the dividends, and the magic there comes in with the fact that when you put it in these policies, it's not beholden to the ups and downs of the stock market, right? It's not like a 401k where you're up 30%, then you were down 20%, but now you're climbing back up. It just stays in there and compounds uninterrupted for the life of it. And if you actually ever look at one of these life insurance policies, you know, it doesn't sound like a lot, but 4 or 5% uninterrupted compounding return on, you know, $100,000 a year is an astronomical amount of money. You don't have to fund it for your whole life. You know, you can fund these policies for only 10 years. You can fund them for, you know, to the day that you die if you want to. But there's all sorts of, there's so much flexibility with these policies, how you can fund them, how long you want to fund them, taking the loans out, right? You don't even have to pay the loans back if you don't want to. And that's another part that blew my mind when I realized that, right? So
how so?
So basically on that $1 million that I took out, you know, I have that loan at 5%. So every year they send me my new, you know, amount to put in the policy. And it's got the policy premium and the paid up additions. So the premium keeps the policy in force, the paid up additions go to the cash value, and then there'll be a third part, which is the interest, right? So all I'm obligated to pay is the premium to keep the policy growing the way that my life insurance, you know, provider has, or agent has designed the policy. You have to put the cash value in the policy. And then I can choose to or to not pay the loan back, right? So on a situation where you wanted to hold a property for 5 years, take 100%, let's say with this property that I bought, I could just not pay for the next 5 years. I could not pay on that $1 million as long as I keep that policy in force. I keep paying the premium, the paid up additions, or even really just the premium. The only negative impact that I'll have is that year one, if the loan's 5% on $1 million, you owe them $50,000. Well, if you don't pay the $50,000, now you owe them interest on $1,050,000, right? So that interest that you owe compounds to them. But let's just say you got a 5-year hold strategy, right? I put the $1 million in. I'm going to get that tax write-off the first year by using 100% of, you know, financing on the property. I hold it for 5 years. The interest that I'm owing is accumulating on the property, but in 5 years I sell it and then I pay everything back, right? I will have to pay the interest on the loan back at some point, but I could not pay that for 5 years. I could enjoy the positive cash flow of not servicing the interest only part of the loan for 5 years. And also the other magic in it is that the loan rate of say 5% is a tax write-off. So every year that I'm getting a bill for the interest that I owe, I can take that to my CPA, give it to him. He can take that $50,000 and write it off, even though I'm not actually making the payment that year on the interest. If that makes sense.
And is one of the ideas here, and why the name of this strategy is the infinite banking, is for a person or a business, you know, not someone of entrepreneurial endeavor to model the banking model.
Yeah, you're just
like
basically taking the function of the bank to yourself, right? So if you go to the bank and you borrow money and you set up, say, an equipment loan at 10% or 8% for $200,000, you can go to the same thing in your life insurance policy and take a loan for the $200,000 out, buy your equipment, and you can pay that 8%. Instead of paying it to the bank, you're paying it to yourself into the policy, right? You're paying it back. Instead of using someone else's dollars, you're using your own dollars in these policies. But you have, I mean, the caveat is you have to have the finances to build up the money to draw from first, right? So that's where it's not for everybody, especially if you want to use it in that capacity. But if you do have a business that generates considerable capital, where you're going to make X amount of dollars predictably every year, and you want to employ the strategy where you can first funnel it into a life insurance policy, and then if you see some opportunity where you can borrow the money at 5% and you can go and buy a deal that makes 12%, you can pay that money back to the policy at a fast rate, and once the policy is paid back, now you basically have no money in the deal, and you're getting an infinite return on that investment. So it's all about changing your thinking, understanding credit spreads, understanding what an infinite return is, and being able to just look at every dollar you put inside these policies, you can really break in, you can consider it as $2, right? One in an uber safe tier 1 asset, gold and silver and cash value life insurance are kind of all looked at the same from a banking perspective. If you go to a bank with a personal financial statement, you'll see that there's a section in there to list all the cash value of your life insurance policies. And they do that because their high net worth individuals typically have a considerable amount in that column.
How do the banks actually make money?
Well, the banks make money by taking your deposits in, right? So they have $10 million on deposit of somebody else's money, and then they go ahead and loan that out to you or to someone that has a credit card, right? So they're giving you, think about you're getting 2% on your savings account and you have $50,000 in there. Well, now they've actually created, on a 10-to-1 fractional reserve lending, they've created $500,000 of, say, worth of credit cards that are out in the world making 18%, right? So they're renting your money to back up their ability to lend, right? And that's actually the scary thing. And we've seen, another great thing about the having your money at a life insurance company is that they're way more scrutinized than your typical banking system, right? The bank only has to have $1 for every $10 that they have on deposit, whereas the insurance companies are held a lot closer to 1-to-1 standards. So if 10 people come to the bank to get all their money, only one of them is going to get their money, theoretically. And if everybody rushes in from a life insurance company to get their death benefit or their cash value, they are required to have that liquidity on hand to be able to pay out to those customers. So in things we've seen with Silicon Valley Bank, myself experiencing as a customer of First Republic Bank, we just don't think that banks are going to fail, but banks can definitely fail. And I have a hedge fund friend that was telling me last week that 200 banks are on a watch list for looking like they're insolvent, like they're going to go under.
Though there may be those that are listening to this that may be thinking that you are an insurance salesman.
Well, yeah, no, I mean that is, I don't sell insurance, but actually I like this enough that I would consider becoming a life insurance agent as a hobby, just to introduce more, people to this. But if you actually sit down and look at the pros and cons of, everybody has a need for life insurance, right? Especially if you have family, you have any kind of assets, everyone, whether it's term or whole life, everybody has a need for life insurance. But for me, this is a safe place to store cash, and everyone needs a safe place to store cash, with the added benefit that I have access to that cash whenever I want, and it will grow predictably over time, and also that it's safe. Another great thing about it is it's also protected from most creditors and lawsuits, right? Because once you sign this contract with a life insurance company, it's not your money, it's a contractual obligation that the life insurance company will lend you a certain percentage based on your cash value that's available. So you're going to be getting the life insurance company's money, and once you give it to them, it's their money as well. But they're contractually obligated to give you access to that money via loans in the contracts that you sign. So you've got asset protection, you've got death benefit, you've got a safe, liquid place to store cash, and you've got predictable rates of return. So if that's what being an insurance salesman is, I guess I'm an insurance salesman.
Yeah, well, I just want to clarify for the audience that, from my understanding, you're not. You're I remember from our last episode, just so they don't, because it almost sounds like a pitch in the sense. No, it sounds like you took your company from 2 million in sales and scaffolding to 10 million by 2019, which is like amazing. And have been growing ever since, from my understanding. And you were exploring ways to grow your wealth for the long term. And this is something that you, through, like you said, very, very, very wealthy people discovered this is a way that you're going to approach it. Am I kind of grasping the general
definitely.
theme?
And what I
Because
look
the
at,
audience doesn't know you yet, Chad, right?
yeah, so if the audience, so I look at these as kind of, they don't call them investment vehicles, but to me, it's kind of a better version of a 401k or an IRA, right? Where people consistently think they're going to put $1,000 a month towards their IRA, right? And in this situation, you could put, say, $1,000 a month towards, a life insurance policy. Well, you're getting the death benefit of the life insurance policy, you're getting the asset protection, you're getting, the safe compounding growth. And then the other interesting thing of it is later on in life, after you've been funding this thing for X number of years and you're 65, 70 years old, you can start to take those loans out for basic living expenses, say on an annual budget of $50,000 or $100,000 a year. Now you're taking that out of the policy with loans, and you have no intention of ever paying those back. So once you've exhausted the cash value, right, the only thing left is the death benefit. And the day that you die, whatever is outstanding, the death benefit's always higher than the cash value, right? So let's just say you had cash value of $3 million with a death benefit of $5 million. You get to the point where, you want to start drawing that cash down, and you think, okay, well, I've got $3 million and I want this to live on for, let's just say, the next 30 years. I'm going to take $100,000 a year, right? So at age 90, you spend your last dollar, right? And that's not taxable, although it's been growing inside that policy. And if you look at how policies grow uninterrupted versus the ups and downs of the stock market, and the predictability of this income, minus the fact that you're not going to pay tax on it, it actually performs, in my opinion, better. And you just have to look at an illustration to see that. But then when you die, like I said, you've got $3 million owed to the insurance company, but you have a $5 million death benefit that they owe you. So they simply cut your heirs a check for, say, $2 million. And you've exhausted that $3 million. You haven't paid any income tax on it because it's all loans, and your heirs get $2 million.
If you were playing devil's advocate, what could be downsides for someone in is it scenario based, or what could be some of the,
so some of the downsides are that you are making, let's just say on a 10-pay policy, right? The first policy I ever started was a 10-pay policy, and I committed to $100,000 a year for 10 years, right? So one of the first drawback is that you don't have dollar for dollar cash value from out of the gate, right? I'm think 6 or 7 years into the policy now. So now I'm to the point where I put the 100 in and it's worth 120, 130, whatever the case may be. But one of the drawbacks is you're not going to have instant access, right? It's not instant gratification. Think of this as building a business, right? You're not going to start making money right out of the gate. So it's like it's anything, it takes time. So that's the first drawback. The second drawback, I would say, is that commitment, right? So you have some good years and some bad years, but the thing of it is you can have flexibility in the policy. So on my policy that is $100,000 a year, I'm obligated to pay $30,000 to keep the policy in force. That's the bare minimum, right? The $70,000 goes into building the cash value as quickly as possible in the policy. But the magic of it is the way my policies are designed, that I could go 5 years with just making that $30,000 a year minimum payment. And then at the end of year 5, I could actually have the ability to put the additional $70,000 that I owed for those 5 years. Say I had some liquidity event, I could put it in the policy, and it was like it tops it up, right? So
catch up kind of thing.
Yeah, you can have catch up. So like I said, there is sometimes, and when I first got into it, I was a little bit nervous because I'm thinking, man, how do I make this commitment? Every year I've got to come up with $100,000. But then when I think, well, okay, every year I've got to come up with $30,000. Well, that doesn't sound as scary, right? And you can multiply that up or down, and they only build these things based on your insurable value. So you go to a life insurance company and you couldn't get $1 million a year policy. You'd have to be able to prove that you had insurable worth that would garner that type of a payment, right? So typically when they assess your life, your life value, it's something that you should be able to make a payment on relative to that every year, right? I have a lot of friends that make a $10,000 a year payment and their minimum obligation is $3,000, right? But they've started that when they're late 20s. And when I look at their projections to the point where they're going to retire, I mean, those are 7-figure numbers by putting $10,000 a year away.
Do you think that you were motivated by that stretch when you took over the scaffolding? Because it sounded like that was years ago, and then you grew the company like exponentially. So was that tied to this? It was like an anchor, like I got to make a certain amount, or I have to invest a certain amount. I got to get out there.
This is when I was really like the company really started to produce dividends for me probably around 2015. So 2016, I was looking for creative ways, to build wealth, to invest, and started, hanging around with some people that were on a different level than me. And this high value, this high cash value life insurance kept coming up in conversation. So I looked into it. I said, okay, well, I'm going to start my first policy and I'm going to dive in at $100,000 a year. And that was a 10-pay policy. So I've got a couple more years left on that policy. Then I'll never have to make a payment on it again. It just sits there and accumulates. The dividend can go to adding to the cash value. I can actually redirect the dividend to come to me and I can, spend it like I'd spend the dividend of a stock. I've got a death benefit that will continue to grow and pass on in the future. So hopefully that answers your question on that one.
Yeah. In closing, how would one go about starting as a business? And is it a business owner mindset only, or would you even say an employee?
No, I would say I've seen a lot of interesting examples where people have simply saved up, say the $20,000 or $30,000 that they would typically buy a car with. Let's just say you're going to go for a idea that you're going to buy a car for cash one day, but you're going to buy with the cash value from your life insurance policy, right? So let's say you take 6 years saving up $5,000 a year. Now you have $30,000 inside a life insurance policy, and you're not making any more payments to that life insurance policy. You're no more obligations to that, but you have $30,000 in there, and you simply do what all Americans do, and you buy a car and finance it. So instead of using the bank's money, you're using your own money. Right. And every time that you buy that car, you trade that car in, you're, using money from your cash value to buy another one and paying it back just like you would any other payment that you're going to have for a car. And I've seen just that simple expense that every American is going to have over their lifetime add up to a considerable amount of money when it's put in that uninterrupted compounding vehicle, which is the whole life insurance policy. So this is the thing that I'm so passionate about. This is it can really be done on almost any level that you can imagine. And I think it's a product that just not enough people know about, and not enough people know about it because when the policies are structured properly, the designer of the policy doesn't make anywhere near the commission they would on a typically structured whole life insurance policy. So I think it'd be helpful. Deal with the right people, you will not get one of these policies designed correctly. You can't just go to any insurance agent and tell them you want a whole life insurance policy. You have to go to a handful of people out there that design these policies correctly.
I think it'd be helpful to, say, to make sure we clarify with the audience. We're not giving financial advice. Chad is giving testimony of his own personal decisions to diversify his wealth. As if you listen to episode 142, the founder of a scaffolding business that's grown significantly over the last, I think, if I can remember correctly, 2012, right? Like over a decade.
It was the LLC was formed in it was incorporated formally in 2004. So next year will actually be 20 years.
And what I'm thinking of is
the pivot happened in 2009 when my dad retired,
so I mean, decades-long business and building wealth for your family for the long term. This is something you're passionate about.
Yeah, and like I said, I'm passionate about it, and I talk to other people because I am on the Zig Ziglar page of helping people get where they want to get, and you'll get where you want to go in by doing so. So I think that, helping people plan for their future, grow and protect wealth is something I'm passionate about. And this is something that people can do at any scale, at any level, really.
In closing, what's the final word? What do you want the audience to take away from this conversation?
You know what? We just kind of hit the tip of the iceberg. If you want to find out some more information on the concept, I have a great friend that writes my policies. His name is Gary Pinkerton of Paradigm Life. You can set up a time and have a conversation with him. He is a certified specialist and he can give financial advice. So he would be the guy to talk to. He's my go-to guy for all these products. And yeah, just watch some YouTubes and, just be open to a different way of thinking about money and thinking about being your own bank.